Hello investors, welcome to Simpli Stocks. In today's video, we will study a very trending and fast growing business from the hospital sector, which is Yatharth Hospital. Yatharth has been performing very well for the last 1 to 2 years, and despite the correction in small caps, it has outperformed. But recently, promoter sell-off happened in this company when promoter Dr. Neena Tyagi sold around her 6% stake in the open market. Since then, a lot of pressure came on the stock and Yatharth has been falling. But on the other side, we see that this is also part of the portfolios of Vijay Kedia and Mukul Agarwal. Both of them have nearly 1% shareholding each in this. Therefore, in today's video, we will study Yatharth in depth. Our focus will be on how retail investors should look at this promoter sell-off. We will see how Yatharth is different from other hospital companies. Along with that, we will evaluate whether this correction can be a good opportunity for new investors who were earlier not comfortable with Yatharth's valuation. But yes, as a standard disclaimer, this video is not a buy or sell recommendation on Yatharth Hospital in any way. You must keep this in mind. With this, let us begin. So Yatharth is a small cap hospital company and most of their hospitals are in Delhi NCR. They have 8 hospitals, out of which 6 are in Delhi NCR, 1 is in Orchha in Jhansi, and they have recently bought another 250-bed hospital in Agra. In total, across these hospitals, they have more than 2,550 beds capacity. Yatharth's ARPOB is around 32,200 rupees. ARPOB, or average revenue per occupied bed, is an important metric in the hospital sector. ARPOB tells us how much the hospital is charging daily from its patients who are admitted there. Please remember this definition because we will be discussing ARPOB again and again in this video. So if we understand in very simple terms, ARPOB basically means what is the rate of a hospital on a per day basis. Yatharth's ARPOB will seem less to you compared to that of Apollo, Max or Fortis because a good amount of Yatharth's customers come from government departments such as army, central government employees or government schemes. In big chains like Apollo and Max, most of the patients are on cash and health insurance. That is why Yatharth's ARPOB is low. So you do not have to judge Yatharth solely on the basis of ARPOB. Otherwise, this business is growing very fast. Hospitals and hotels are your asset heavy businesses. It is difficult for such businesses to grow fast as it takes time to construct a new hospital building and then make it profitable. But execution of Yatharth's management has been very solid. In the last 1 year alone, they have added 700 new beds. Their 2 hospitals have recently gone live, one with 300 beds in Model Town and another of 400 beds in Faridabad. Now, an interesting thing that has happened here is that despite these 700 beds going live around the same time, their occupancy rate has not fallen. Occupancy rate basically means what percentage of your hospital beds are occupied. So when any hospital company launches a new hospital, adds new beds, then the occupancy rate usually falls because it takes time to bring patients to a new facility. But here, even after such fast expansion, you will see the occupancy rate has actually improved. It has increased from 60% to 66%. So if you look at KIMS, then you will notice that occupancy has fallen there when new hospitals have gone live. Therefore, this gives confidence to Yatharth's investors that on one side, the company is bringing capacity and on another side, also managing its occupancy levels very well by attracting patients. And right here, you will also see that ARPOB grew by 5.2%. ARPOB has increased from around 30,600 levels to 32,200 rupees. Apart from this, with the time, Yatharth's business model has strengthened and its revenue base has diversified. You will see 4 years ago, their entire revenue used to come from just 3 hospitals in Noida, Noida Extension and Greater Noida. But now their base has diversified. With that, concentration risk in the business has come down, and going forward as the contribution of Model Town, that is Delhi Hospital, and Faridabad and Agra hospitals will increase and new hospitals will come, Yatharth will keep getting more diversified. And in their investor presentation, you will notice one more interesting thing, that in the last 4 to 5 years, the contribution of super specialty treatments such as oncology, which is cancer treatment, nephrology, urology, spine surgeries, etc. has increased. Hospitals earn more from these high-end treatments. That is why the ARPOB of Fortis and Apollo is higher also, because the contribution of super specialties is higher there. Earlier, 56% of Yatharth sales came from ordinary internal medicine, the contribution of which has now come down to 19 to 20%, and the share of super specialties has increased. This is a big trigger for ARPOB improvement in Yatharth. Please listen to me carefully now, you will understand. ARPOB grows because of the addition of super specialties. Hospital companies are able to charge more from their patients by giving these high-end treatments, and then obviously sales growth improves. So super specialties help a lot in bringing ARPOB growth. However, for the big branded hospital chains like Max or Apollo, ARPOB growth can only be in the 3 to 5% range in the long term, because super specialty treatments already account for majority of their revenues. So there is not that much scope for ARPOB to increase. But a player like Yatharth will have more headroom to grow ARPOB, which we are also seeing playing out here slowly. I believe their ARPOB can grow at a rate of 10% in the medium to long term. Therefore, with new hospitals that Yatharth is bringing, growth will come from there. Along with that, ARPOB will also bring revenue growth. So here we will get to see both value growth and volume growth. Now a humble request, if you are liking this video so far, do give me a thumbs up. Along with that, you can also subscribe to our channel Simpli Stocks. Your likes and subscribes are the only motivation that keep me going. And if you subscribe us and you like our videos, we will be much more motivated to bring such videos for you every week. Let us move forward now. So far, we have seen that overall, Yatharth is in a very good phase. Their occupancy levels have remained strong, and the company has been adding super specialties too. Now, let us quickly look at their results. In the 6 months from April to September, their sales have increased by 25% over last year. However, as 700 beds capacity came at once, we are seeing margin compression because of that. Their EBITDA margin, which used to be around 25%, has reduced to 23% in Q2. And the reason for this is, when you start a new hospital, you have to keep nurses and doctors from the first day. Expenses start from day one, but patients come slowly over time. Therefore, pressure remains on margins in the short term. Many entry-level investors just keep looking at margins in the hospital space. But expert investors understand the long-term capex cycle. That is when and how, capacity is coming online. Besides, adding 700 bed capacity suddenly to 1600 beds is a big expansion. For this reason, we have seen such margin contraction in Q2. But going forward, margins will get better. Their target has been to achieve 3000 hospital beds by FY28. Until last year, they had 1605 beds, and then 700 beds came through Delhi and Faridabad hospitals. And now 250 more beds have been added from Agra Hospital. So total capacity is now more than 2,500 beds. Yatharth will easily complete its 3,000 beds target, which translates into 23 to 25% CAGR volume growth in terms of capacity. Meaning this is that growth in the business which is coming only and only from adding new hospitals and new beds. If we take an estimate of roughly 25% volume growth and add another 10% ARPOB growth to it, that growth which will come from increasing rates, then Yatharth easily becomes your 35% type growth engine. And I told you that hospitals are asset heavy businesses, right? So 35% sales growth in an asset heavy business is a big thing. Although investment is more initially, therefore pressure remains on the margins in the short term, but in the long term, this becomes a defensive business. And because of this asset heavy nature, hospital sector stocks always receive premium valuations. You will see almost all businesses trade at PE ratios of more than 60, but Yatharth is currently trading at a PE of 40 to 45, which is a much lower valuation than other players. So you are seeing right how a business growing so fast is available to you at the lowest valuation in the sector. And suppose for a moment, if company stops expansion, then margins will improve immediately, profits will increase, and PE will look even lower. Therefore, you do not have to reject this business by looking at this 40-45 PE. You must understand the reasoning behind it. And from my understanding, Yatharth's journey has just started, and the next 2 to 3 years can go very well for this business. Now, regarding the promoter sell-off, personally, I believe that if there is no problem at the business level, then promoter stake sale should not be taken very seriously. A promoter can sell a stake because of their personal reasons. Although the problem in Yatharth's case was that Dr. Neena Tyagi dumped all her shares in the market, because of which the stock corrected a lot due to heavy volumes. The market sentiment has become temporarily negative regarding Yatharth. Otherwise, usually in such block bulk deals, what happens is sellers find a buyer through an investment banker. You sell shares here, there some mutual fund or institutional investor purchases them. In such a case, even a large stake gets sold and pressure does not come on the stock price. But this sell-off happened suddenly from promoters' side, and that too in the open market. But Neena Tyagi is not part of the core management. She is an extended family member. For this reason, shareholders should not take too much tension, I believe. In fact, because of this sell-off, the opportunity has become better. Otherwise, you will see that while other small caps have been falling, Yatharth was making highs after highs. So Yatharth is a good fast growing business which you can study yourself. And if you did not like the video earlier, my humble request, please do it now. And you can also subscribe to our channel Simpli Stocks. For us, your likes and subscribes are the only motivation that keep us going. With that, I'll end it here. I will see you in the next video. Happy investing.